Hey, everybody, I'm Alex Steele, Bloomberg Television, and I'm joined by Jon Gray, President and COO of Blackstone. He really needs no introduction, but I gave him one anyway. Jon, it's good to talk to you. First off, how are you? How you doing?
I'm doing fine, Alex. It's obviously been a difficult period for lots of people, but I'm happy to be here.
And we're really happy to talk to you. There's a lot to get through, but I do want to start with the craziness that we're seeing in the market with the Reddit guys and the hedge funds and the short covering and the volatility. You've seen a lot of stuff. This is new. What do you think about it?
Well, we tend to be long-term investors. And so we look at things over a period of time and we try to analyze companies and figure out their value, their cash flows, their growth prospects. And what you're watching now is obviously something that's very different. And what concerns me is when asset values decouple from their underlying value. And that becomes a challenge because at some point we know from history they will converge. And that's what I think is likely to happen over time. And I worry a bit about what happens with individual investors who are participating. I would recommend trying to take that long-term view with investing.
And at the same time, I mean, you guys do have positions in hedge funds. I mean, some of the moves we've seen for hedge funds have been extreme in the last few weeks. Some actually have to get cash infusions. Are you worried about your exposure there at all?
Fortunately for us, it's not material to our hedge fund solutions business, but there have been hedge funds hit. And I think one of the lessons here, again, is how much leverage hedge funds operate with. Because what happens is in a crisis, it can be like the pandemic, it can be a natural event, or it can be something like this. When you have short duration debt and there's a big spike, you can lose your assets, even if things are moving, in the wrong way for a period of time. And I think that's really the takeaway from this situation.
I feel like crash up is something that can be coined, right? We're used to crashing down. This is like a crash up. Something that obviously, and this kind of pairs with 2021 and the Biden administration, this we're seeing more calls for that now regulation. Things like leverage, things like how many short positions someone can hold. Like, what do you think the evolution of this will become?
Well, I don't know. Regulators are obviously going to take a look. On the one hand, you can't discourage individual investors from making investments they want to make in the market. The question is, are folks trying to guide things to generate short-term gains? I think there will be more scrutiny. When they look at leverage, the question is, are there systemic risks? I don't think there are from this. So from that standpoint, they're just people taking losses. But as we move into this sort of new distributed social media led world, it creates new challenges for all of us, I think regulators in particular.
Yeah, and it really also highlights, I mean, there's one article in the FT today about how this is the next iteration of the Wall Street protests that we saw years ago and sets up a Wall Street versus Main Street. How do you at Blackstone tackle that narrative?
I'm not sure, and I don't know. Some of this may be Wall Street versus Main Street. Some of this may be just traditional greed. People trying to, tulips rise up. People go after things as prices rise. But there could certainly be this element of the small person versus Wall Street. For us, again, our approach is we're stewards of capital long term. We raise capital from our investors. We try to invest in things we believe in. We try to add value and generate favorable returns. I think that is a much more sound approach to investing, and we try not to get caught up in the heat of the day.
That's fair. All right, you just had earnings yesterday. I mean, you had really stellar numbers. If you were to look ahead to 2021, what do you think we're going to be talking about in a year?
Well, that's interesting. Yeah, no, we had a terrific quarter and we were excited about that. Obviously, we had great returns for our investors and delivered really terrific earnings, and we saw a lot of inflows. And it was on the back of some good decisions we made in deploying capital and a lot of growth we're seeing across the firm. As we look forward, I think a year from now, we'll be talking more about an economy that has reopened and has tremendous strength. I think it's hard for us. We were just talking off air about this feeling of being trapped at home that so many people have. People want to get out. And so there's a sort of a global cabin fever phenomena that I think is going to reverse itself when we get back out. People are going to take, planes, they're going to get in cars, they're going to go places, they're going to go to restaurants, they're going to go to ball games. Consumer savings are at record levels. Credit card debt has been paid down. And so I think we could see a surge of economic activity in the second half of the year in a post-pandemic world. Now, for investors, I think what's interesting is you may see commodity prices go up. You could see wages go up, which is obviously good for lots of people, but we could see inflation higher and the long end of the yield curve go up. In China today, the long end is back to where it was prior to the crisis, which is not a surprise given their economy is mostly reopened. And when that happens, it could impact asset values. So I think what we may be talking about next year is, whereas 2020 was the year markets moved well ahead of the economy, the back half of 21 could be a period where the economy moves ahead of the markets.
That's a really interesting way of phrasing it. And I wonder, we're all trying to figure out, like, what is that level on the 10-year or the yield curve that's going to wind up affecting asset prices?
It's very hard to say. I don't know, but obviously, if the 10-year went from 1 to 2, that's a pretty dramatic move. I think the most vulnerable assets would be long duration fixed income because there's not a lot to hide. If you bought a bond that yields less than 2% and the 10-year goes there. For companies, it'll be a mixed story. Some companies will get a real pickup in business activity. But others that are more bond-like, there could be a little more risk associated with them. So, I think it's hard to say. I'm not necessarily saying, calling for a sharp decline in markets. I'm just saying that, we benefited from this great stimulus and very accommodated policy and very low rates. And some of that, certainly at the long end, could go away and it could impact values.
So then it's like a two-for question. What assets would you are immune from that you guys are investing in? And if there is a decline in asset prices that's material, kind of what's on your shopping list?
So I would say generally, maybe I'll answer them both together. Where are we looking? I'd say one place is COVID impacted businesses that we think will recover sharply. So if you buy into my scenario, you'd want to own transportation infrastructure, rail, roads, airports. You'd want to own location-based entertainment. We own a water park business. People want to take their kids back out. You'd want to buy hotels. We've been big investors in hotels over time. I think you'd also be more inclined to own shorter duration floating rate debt. We like that in the private markets where you get a little bit more spread. And then I would say more broadly, and this has been going on with us for a number of years, there are still these big economic changes driven mostly by technology that I still think you want exposure around. So goods are moving increasingly online. And we've been the largest buyer of global logistics. Today, we own $100 billion. It's our biggest exposure at the firm, particularly around what we call last mile warehouses. We bought some assets in China recently. We did a deal in Southern California. We like that. Content is moving online. Video games, movies, music. We just bought a video game online advertising business. We bought a bunch of studios in Hollywood. Cloud migration, software moving to the cloud. That's something we continue to like. We've done a number of things in enterprise software. You need the digital infrastructure to back this up. So the data centers, the fiber, the towers. I would also add this big push into green will continue. And today in the stock market, some of those stocks have run quite a bit. But the overall trend going from less than 10% sustainable energy sources to a much higher percentage over the next 20, 30 years means huge need for capital across wind and water and solar and battery power. And those are areas that are interesting. And then I'd say life sciences is another area that we're enthused about. It's been our biggest theme. We've sort of done it beaker to bedside. We've done it in places like life science office buildings. We just bought a big portfolio in Cambridge, Massachusetts. We've done it in commercializing life science therapies. We've done it investing in individual drugs that treat cancer, bladder cancer, kidney disease, diabetes. So we're spending lots of time in that area. And then the one other thing I'd say about some of these themes is they're not all technology driven. Aging populations will continue. We've played that in Japan with over-the-counter drugs and generic pharmaceuticals. Rising middle class in places like China and India. There we've invested in things like education and consumer finance. And then alternatives, the sector we're in today, continues to have a big boost, and we invest in secondaries and stakes in managers. So it's obviously not an easy time to invest capital, but I do think looking at these big thematic changes happening in the world makes it an easier way to invest.
So that's actually a good segue to this question that we got from a viewer saying the U.S. economy shrank by 3.5% last year, the worst year for growth since World War II. What will building back the U.S. look like? And in particular, how will young people and the future of our workforce be impacted? And I think that also builds on a theme of the migration we've seen out of cities. You have been bullish on cities like Tennessee, Nashville, Austin, etc. I know you guys are starting a tech branch in Miami. How do you see all the chess pieces?
Well, I do think lots of things will go back to the way they were. I do think many of us are going to go back to offices. I think about our company today. We have a subset of us here. We've been able to do that through testing, contact tracing, paying for people's transportation, and we do it on a voluntary basis. But having people in the office together makes us more productive. It allows us to interact, call people together. Today, we do it in mass in a conference room, but that's really helpful. Training young people, I think, is virtually impossible in a Zoom world. It's a great technology when you've worked together for a long time and you have a lot of social capital. But for a young person who just is getting a job, to be in the office, to lean over to the cube next to them, I think that's really important. So I do think we'll mostly go back to office. Some functions will be done in maybe a hybrid role. So there may be some decreased demand for office space, but overall, I think people will come back together. And then to your question of where will they go, I still think urbanization continues. I think the big cities will recover. New York City is going to come back. I know its demise is talked about quite a bit, but this city is going to come back. There's so much energy here. I think about my daughters leaving college with their friends. They're all at home. They want to rent apartments and start their lives. They want to come to New York City. So I think a city like New York will come back, but there are some headwinds here, no question about it. Issues around the cost of living, taxes. People have now experienced living in places like Austin or Miami. So that's a headwind. And some of those cities will benefit, no question about it, where you'll see movement to Nashville and Austin, Salt Lake City, Raleigh, Durham, Miami. But I think urbanization overall will continue. The big cities will come back. They do have to make good decisions, I think, policy-wise, over time here, which is a challenge. But some of these emerging cities will have a lot of momentum. So I don't think this will end up all of us living in suburban and rural areas. And the trends globally towards urbanization, I think, continue.
So quick question on that before I ask you a question about Miami. So I know we're talking about residential, but then when do you see sort of the bottom in commercial real estate prices in some of the hubs that are getting hit hard, like in New York?
So real estate tends to lag. I think apartment values are probably, will probably bottom out here at some point fairly soon because I think people are going to start moving back in to the cities, which will help the apartments. The office market takes time. Companies are now uncertain about their future. What are they going to do? How many people will be in the office? Vacancy rates in places like San Francisco have gone from 10% to 20%. You guys had an article about London, the sharp increase in vacancy there. So I think that will take some time, but ultimately there'll be a recovery. There'll end up being less building of new office buildings around the world. The existing buildings will absorb the space. It may take a number of years, but we're probably not necessarily at the bottom for valuations yet or the bottom for the rental markets here. That maybe they've sort of bottomed and maybe we plateau at this level for some time.
Do we need to get to like herd immunity to call a bottom? Or, I mean, is it just, how does that recovery play out?
Well, herd immunity definitely is going to get people back in the cities, get confidence back, leasing activity. The apartment buildings will fill up. Certainly the hotels will come back today. Many of the hotels are closed in these places. And then the office buildings will take time. I think what will happen is some companies will come back. They'll find that, wow, this is good, being in the office, talking to the person next to me for culture, for integration. For us, we view our business as a team sport, the way we do it. And I think that will lead more companies to come back into the office, and that'll lead to a recovery. So, yeah, I would be willing to make bets certainly around these urban centers and buying assets at prices that are down from where they were prior to the crisis.
Um, are you going to be buying a house in Miami, like everybody else?
I don't have any plans today to do that, but I think Miami's got a lot of tailwind. We actually chose Miami as a second location for our tech group when we were looking for another location that had good quality of life and we could attract diverse talent. And Miami really hit the radar for us, and we decided to set up an office there. It doesn't mean we're moving from New York, but we are going to have more people down there in the tech space. We think that's a good thing for our business over time. We're obviously, as a firm, growing fairly rapidly.
Well, this actually ties into the next question from the audience. The question is, what are the top 3 investment opportunities the pandemic has thrown up, which I think is a pretty funny way of phrasing that. Are there new areas of investment that we might not otherwise have paid attention to? Miami was already a thing, but it became much more of a thing. But it is a good question, something that has happened that you weren't expecting.
Well, I think the biggest thing is the acceleration of these technologies we talked about, which is, sort of the Zoom world we're living in. By the way, climate would be a great example. People had talked about the risk for vaccines for a long time, the risk of a pandemic, the need to create vaccines, the need to be prepared. And we ended up as a society around the world paying the price. And I think this has now created more urgency around climate. So I think there's been a real acceleration in that area. Back to my earlier comments, clearly sort of this movement from offline to online of almost everything we do in our daily lives, I think will continue and accelerate. I think it will also accelerate things like digital payments in a huge way. I mean, something like 77% of transactions globally are still done by cash and check. And when you throw in credit cards, digital payments are a tiny percentage. We've all learned we can pay for lots of things doing this. I think telemedicine is probably the biggest winner or one of the big winners coming out of this. Before, because of privacy rules, health insurers and doctors, everyone was nervous. Now, so many of us are having doctor's appointments. That's an area. So again, I go back to what's changed in our lives. We're probably less likely to watch movies in a movie theater. We're more likely to now stream that. What's become a permanent sort of acceleration and secular change as opposed to something that's cyclical. On the flip side, I think, how many pet houses, how much soup can we make at home? There are some activities, cooking or eating out had been, climbing for 30 years. And then we've seen this massive decline and huge surge in home cooking. That's probably not going to continue. And so you want to try to separate the cyclical from the secular. And if you identify those trends, find attractive ways. And one other thing I'd say about that is some of the on-theme trends are very expensive in the public markets today. And what you love to do is find things that are sort of one derivative off. Something in the supply chain could be compliance related to that growing trend. That's a way to play these things. It's not necessarily the direct software or app itself.
That's such a good point. We only have like a minute and a half left, and I did really want to get to climate, because something that we might see from Biden administration would be more clarity on like what ESG actually is and better disclosure from companies, which would help investors like you. And I'm just wondering, like, it's been so popular, and we talked about how some of like the solar stocks really ran into Biden. What is that derivative right now in the climate investment story?
Well, for us, it's obviously looking in the private markets. So finding companies, particularly growth companies that need capital, companies, the battery space we really like. We invested in a company out of our energy fund. We've invested in some companies doing things around building management systems and energy efficiency. And then there are folks that are in that supply chain manufacturing some of this. I would also throw in there utilities. If you think about utilities today, what they do is mostly off of hydrocarbons. Still, many of them rely on coal. Over time, they're going to have to invest significant capital to become green, and they get a guaranteed return on that capital they invest. And so that's an interesting derivative play to what's going to come, we think, in renewables.
Oh, really good point. Do you think that Biden needs to sort of lay out some more clarity on what disclosures are and definitions? Like, would that help you at all?
Well, I think you've got to give the administration a little bit of time. They've got a lot in front of them. The crisis, the pandemic is obviously a massive issue. I think they're very focused. They've got a number of people in the administration who've commented on this area. The president himself has made a number of very strong statements. I'd expect that there'll be more, and I'm sure it'll be around all sorts of things in energy efficiency, new building standards. I think this is coming really not only here in the U.S. but around the globe. We're seeing it, and this is a mega trend. And as I said, hydrocarbon usage will go down. It's not going away. It's going to take a long time, and that energy
Yeah.
infrastructure will stay. But as investors, you want to think about how can I benefit from this coming transformation?